Welcome back, everybody, to Markonomics 101 presents Hoot Loot, the place where you come to be informed, be amused, but never be misled. Today, I don't know if I'm going to amuse you too much. This show is called Beware the Ides of March, and I am here where Julius Caesar was assassinated. Well, actually, that date was March 15th, is the actual date of the Ides of March, but they also signify something going on in the markets, and that is something that is a turning point and is negative. And we've been kind of talking about this for a while here, and the red flags are out. So we're going to get back in a minute here, and at the very end, we're going to announce the winner of our promo. But right now, get prepared for not the best message in the world. We'll be right back. Welcome back, everybody, to Hoot Loot. This is the show called the Beware the Ides of March, and we're going to show you why this is a very treacherous time for everybody, and that's why this message is a little gloomier than normal. But yeah, we saw the bad moon horizon. That had a little humor in it. This one, I don't know. We'll have to dig some up somewhere. But the Dow today, it looks really close to breaking down from this ascending wedge, and that's always a bearish pattern. It's really close. The reason we think it will is because other things have broken their patterns, and it seems to be that the weight of negative patterns is really pretty heavy right now, and it just says watch out, caution, beware, so loudly. So the NASDAQ 100 is kind of the leading edge, and the reason that we love to look at it is that this is kind of the leading edge of where money has gone. And you look at this thing, and it is now broken down out of a rounded top at today's trading. It looked really heavy, and we talked about Apple last week and things like that. So right now, this is looking like the leading edge of something bad coming. Okay, the S&P small cap index, I don't quite understand why, but these actually have held in there pretty well. But I would expect that these will follow suit at some period of time, especially with most of the money going to be sucked out of the market here. The S&P 500 also kind of on the edge of breaking down. It has a lot of the large cap stocks in there, and the Dow is more the banks in there, and that's, again, the banks kind of held up a little bit. So a Dow Jones Transportation Average, well, this one's held up pretty well too, and that's kind of interesting. Normally, it's a very good indicator of the economy. Right now, it's still in a bearish pattern, but it continues to hold up. So we'll continue to monitor this, but transportations absolutely will have to break down as part of all of this to break down. I don't know why they would not, but they probably will. So now this is the big news of right now is interest rates, and everybody's going crazy about rates. About rates, how they're rocketing up. Even though we've been talking about inflation, we had Inflation Nation, a couple other shows way back when, telling you exactly about that this was coming down the pike. Seismic shift, this was coming down the pike. We talked about it, commodities, and and that versus paper currencies and interest rates. Well, here we are. This is how quickly an ETF can go down in capital with just a little move in interest rates, 7 to 10 years only. And look at that, just descending, cascading move. And the 10-year is still only at 1.45%. It could go to like 3 or 4 or 5. I mean, historically, the 10-year and maybe the 30-year have been like, say 4 to 5 on the 10 and 5 to 6 on the 30-year. That's historical average. What if they go to that level? Then you still got like multiples of where they are now, and they could go even higher because you just don't know what kind of inflation is coming down the pipe. So, and here again, 20 plus year treasuries, you can lose a bucket of money in these things really fast with long duration like that or long maturities. And if you are at risk this way, there are ways you can hedge your risk. And this one right here is one of the ways to do it, because you don't want to be caught with on the other side of variable rates and having taken the risk of those right now. This right here is an ETF that'll hedge you pretty well against them. It goes up when rates go up. So that's actually a decent thing to own right now. But otherwise, it's still, cash is a good place. So right now, Apple's important. I want to talk about one of the things we do is we kind of go from section to section, and this is now going to be a section of big cap technology stocks. Why? We put them all together because they're an indicator of sentiment, of market sentiment, of group behavior. Not necessarily any one by itself, but all of them taken together start telling you a story of the market falling apart. And that's one of the reasons why we're kind of we're feeling the Ides of March today. But Apple was the first one we pointed out like probably 2 weeks ago or a week and a half ago. It had broken through its trend line, and that was not a good sign. It was kind of alone, but it did lead. It started to lead the others. Amazon, exactly where it wanted to be. Amazon's another one that's following suit. This is a bad sign too because it's a big retailer. So it's held up reasonably well, but now it's falling down too. And one of the reasons that this particular sector is so good here, at really looking at it, is because higher interest rates, long-term rates, scrunch the PEs of these kind of companies and will make them, even if their earnings continue to go up, we'll just have them trade at a lower PE because they have to compete against bonds. And it's simple as that. That's why they go down in value. So it's not just that there's something bad going on with the company. It could be just the fact that they are less valuable in a higher interest rate environment. Simple as that. Now, in some cases, there may be some problems. Who knows? But in any event, Facebook held up pretty well. The reason it's in red is because it probably joined suit, but it's actually held up pretty well. It's still in danger of turning bearish, but it hasn't really turned bearish. So I could give this kind of a neutral. Google actually, I think, is very much at risk of actually going and gapping through that island. Google is one of those companies that is just had a wonderful run, but right now higher interest rates are going to scrunch its multiple, and that's the thing. All these companies trade at some kind of high multiples, and there's nothing you can do about it, even if their business is good. So it's a matter of competing with another asset class which is going up in what it offers. So when the 30-year goes up to almost 2.5, it starts offering something other than zero. The 10 years at 1.5, oh, whoopee-doo. Okay, but they're actually much higher than they were. So, at some point we'll get to some normalized rate, and, we'll see what happens. There'll be a shakeout in some of these stocks because of that, most likely. Microsoft, this one is, again, looking pretty good, but also kind of breaking down here, a little rounded top here at the end. And I would imagine that this will break down too. It's a high multiple company, good company, nothing wrong with it. But, it's got to compete against these higher interest rates and inflation and all that stuff. That's why that was so important way back when. NVIDIA, this is one of the high flyers in the semiconductor area. This one's just breaking down at the end of trading today, and it looks bad too. Semiconductors are always like the last gasp of strength, and it doesn't look good that NVIDIA, which is everybody's darling right now, is breaking down. Also Qualcomm, which is another one of the darlings too. This is kind of a second tier NASDAQ big cap company, but still very indicative, and it's breaking down from around the top. And this one I love more than anything else, not just because of Elon and his attempts to demolish me, but my attempts to demolish him too. In any event, Tesla is one of the reasons I like this so much. Forget about the fact that that the financials don't make sense and nothing makes sense about this company. Okay, but look at it as purely a gauge of sentiment only. Okay, just think of it as that. The people who buy Tesla are very indicative of a certain investor class. And when they start breaking down, when this investor class, which was probably among the marginal classes that was late to the party, starts getting back out, which is what it looks like here, that's where we see an indicative sign of something bad coming down the pipe. Beware the Ides of March. All right. Gold, here's another thing. I don't like this. When gold breaks down in an inflationary environment, that's not good. That means, in all likelihood, liquidity crisis coming. So you need to be liquid in order to benefit from a liquidity crisis. Okay, if you are not liquid, then you're not going to benefit from it. Silver too. There's all this talk about a short squeeze. I don't know if it's going to happen. It may not. But I'll tell you this. The precious metals don't look that good. They ought to look much better than they're looking right now, and they don't. So you have to pay attention to that and say, well, maybe later down the road. But right now, this is only consistent with the liquidity problem. And the bank index, I'm not quite sure why this is going up, but this is one of the last bastions of strength in the market right here. As is the broker-dealer index. I don't really get it, but they see all these IPOs coming down the pipe. So The Airline Index, this is among the only amusing things about today, okay, is the Airline Index. Okay, we've got a bunch of companies that are all pretty much bankrupt who don't like higher interest rates because their capital structures are all heavily financed. Okay, they have planes that are not being used. They're getting bailout money of hundreds of billions a month to the industry, and who on God's green earth is chasing this stock higher? That's all I want to know. This index higher. Oh my God. Oh, here it is. Jets ETF. Here you go. If you want to really understand, look at this thing. It's like parabolic on parabolic hope. That's all I can tell you. Let's see. Biotechnology, again, breaking down, not looking good. Now, the REITs, real estate, what we kind of said last week was higher interest rates and higher inflation are going to work both ways. The lower dollar will help real estate, but then on the other hand, higher interest rates will hurt real estate in the competition and financing it. So you have to kind of have to go somewhat neutral on this right now. Big oil, as we mentioned before, big oil, it's bullish above this 950 level, but on the other hand, shale oil is gonna start coming out pretty soon, and it will be just as much of a problem as it was to them before, I think. Bank of America looking parabolic right here. Oh my God, Warren Buffett is looking good. I think this is one of his favorites right here. But look at that, just going parabolic, nuts. Um, okay, now that's that's the funny stuff. The bank's going parabolic. All right, now Costco wholesale. This is serious. Retail is 70% of the economy, 70% of GDP. All the retailers are breaking down. We saw Amazon before, Costco right here, and it's a Dow component. FedEx, transportation company, look at that, kind of hanging in there, but not really. I expect this one will break down too. Goldman Sachs, well, I don't quite get this, but on the other hand, I guess there's a lot of deals they still expect to have, so we'll see. But Goldman Sachs is completely in an exhaustive move. I'm not quite sure if that's all IPO anticipated or what, but we'll see. Home Depot, again, another major retailer that kind of a secondary retailer is broken down. Look at that, and it's gone bearish. Dow component too. This one I wanted to show. I haven't showed this one in a long time, but this is the Renaissance IPO ETF. What this one does is it's an ETF of recent IPOs and IPO activity, and basically this thing continued to be bullish all year long, but look at this rounded top that it's making right now, and that tells you that maybe the IPO calendar from these particular investors is not looking so good, and maybe won't look so good for Goldman Sachs. I don't know. It looks like they don't quite agree. We'll see which set of people is right. JP Morgan again, going parabolic like the banks. I don't get it, but today up there to make maybe a double top. I don't know, but it was up big, huge, and I know Warren Buffett sold this, so that was probably a good call. I would think you got a good price for it. I don't know how it could go much higher, but we'll see. Nordstrom's, that does look like a Head and Shoulders to me. So the half retailer that we call Nordstrom's, the 4.5 retailer, that one looks like it is going to make a Head and Shoulders, and it will come down. I probably think that because of all the other ones are saying that. Procter and Gamble, this is what those stores selling them as Procter and Gamble products, and these diseases aren't going too well either. And this is also a Dow component. This is a very important company. Not good. Lots of red here today. Notice that? Lots of red. Yeah. Pioneer Natural Resources. Well, this is a shale company. So as you can see, shale companies are pretty happy sometimes. This one is really happy this time now that oil's gone to 60, 63. And companies like this will have a lot of production on hand pretty quickly. So it's hard to imagine oil going much higher than where it is right now, or maybe stabilizing within a range of like $10. We'll see. We'll see. Retail ETF has broken down from an ascending wedge. Bad pattern. These are the big retailers. Well, what else can I say? Not good. Target. Oh, I'm sorry, but look, a couple days ago announced good earnings and just got pummeled on it. That's not a good sign. That's a sign investors want out. And Target here just got pummeled and beaten to death here, and it broke its trend. So that's another bad sign. Now we're going to UPS, and as you can see, it's breaking down, we believe, from around the top formation. Again, this is a bearish pattern. This is a sign of losing strength and gaining weakness on the downside. So when it hits this kind of pattern, it usually ends badly. It did in Walmart's case. Walmart shoppers, are you tapped out? Yeah, I think we are here. Look at that. Just doesn't look good at all. So again, another bad one. We want to thank you very much for tuning in. Please like and subscribe. On a positive note, I want to tell you that if that the promo winner of last month's promo is Elizabeth Mariscal, and she's the winner of our $200 Visa gift card. Thank you, Elizabeth. We appreciate your subscription, and we'll announce another promo next week. So thank you very much for tuning in. We'll see you next time. We'll try to be a little more amusing next time and a little less morose. See you then.